This podcast is brought to you by Nuveen and Ruffer. Nuveen has provided investment excellence for 125 years. With expertise across income and alternatives, Nuveen continues to expand its capabilities while maintaining its legacy as a leading investment manager. Visit nuveen.com to learn more. Investing involves risk, loss of principal is possible. Ruffer is a London-based asset manager founded in 1994, managing over $25 billion for institutions, pension funds, charities, and individuals. They have a single investment approach that aims to deliver positive returns across the full range of market conditions. Investing involves risk, loss of principal is possible.
So the total portfolio approach gives you an opportunity to have a better diversified portfolio. You can really get at the underlying risk return drivers. Again, your goal is overall total portfolio, not specific to maximizing the returns within an asset class. It also creates a flexibility because you can move between those asset class labels, and asset classes to some extent are substitutable for each other. So if I think about private equity as being a leveraged form of growth exposure, or real estate being a combination of growth and inflation exposure, kind of equity and fixed income, I can think about keeping the overall portfolio level by moving between those. So there's a flexibility that is afforded to using that total portfolio approach, which is not there when you use the more classic strategic asset allocation. It also helps us resolve the curse of dimensionality because we are not trying to solve for many, many different things. At its core, we're trying to solve for a very small set of macroeconomic exposures that we want to keep the portfolio robust to. So that helps us on that front. So I really do think it overall gives you a better insight into your portfolio and a better ability to control the risk return profile of your portfolio.
I'm joined today by Derek Walker, who is Head of Portfolio Design and Construction, Total Fund Management, and a member of the Global Leadership Team at CPP Investments, based in Toronto. He previously worked to Morgan Stanley in Geneva. Welcome, Derek. Thanks for joining me today.
Thanks, Ethan. It's great to be here.
Well, great. Well, let's start where we always start. Can you tell us a little bit about your background and how you came to this role?
Yeah, thanks for asking. I would say my career has been a bit non-linear. So I grew up here in Canada. I did my studies here. Upon graduating, I wanted to see the world. So my early career was actually in Europe. I've spent about a decade there. And from a professional or personal interest standpoint, I've always really been interested in technology and systematization, but also called the human condition. And so humans are really innately social creatures. And so I began my career in machine translation, that language plus technology, and trying to think about how you take that action and process that a translator does and map that into rules and map that into programs and help make that process more efficient. And of course, in Europe, and this was in the 90s as the EU was coming together, there was a great need for a lot of translation work to happen, which was one of the reasons that I made the move there. At some point along the road, I became interested in another dimension of the human condition, how we interact on more of an economic plane. So became quite interested in investments, economics, and so forth, and made a switch over into the world of finance and the world of investments. So that was about 20 years ago, and I've been in various types of roles since then. But I would say overall, it's been an unexpected journey.
Well, that's really interesting. And when we start talking about the total portfolio approach, we'll come back to that systems thinking, because I'm sure there's some overlap between holistic look like that and how you think about a portfolio. So can you talk now about your journey within CPP Investments and your move from MSCI over to there?
Sure. So I've been in the organization for about 16 years now, CPP Investments, and it's been a really amazing evolution, both for me professionally and also for the organization. And maybe before talking more about me, just a little bit about CPP Investments, since perhaps some of your listeners are not as familiar with our organization. So CPP Investments is mandated to invest the assets of the Canada Pension Plan, which is one of the pillars of the pension system here in Canada. So we're actually investing on the behalf of 21 million contributors and beneficiaries across the country. So CPP Investments, we operate at arm's length from government. And we were actually set up in 1997 by an act of parliament to ensure that the CPP plan would remain sustainable. And so we were given a pretty broad mandate back then in terms of how we would think about investing. And this has taken multiple iterations and evolutions over the years. And it's been, again, great for me to be part of that. So if I wind the clock back, so from my prior career at MSCI, and then I also had some time at a quantitative hedge fund based in Europe before I joined the fund. I joined back in 2008 and fortuitously right before the great financial crisis as it happened. But this was a really interesting time to be in this organization. We were building out our capabilities around active management. We were adding new investment teams to support different types of investing capabilities across that spectrum of different types of active management. And I was hired as part of that wave of building out those capabilities. It was a really fun time. Often, whatever you wanted to do, you were the first person in the organization who had tried to do it. So it was a really fun time to be part of the journey of CPP Investments. And the next evolution, to my mind, is what we're talking about today, this total portfolio approach. So those first several years, we're building up that capability around active management. And then that next phase was great. We have all of these amazing active management capabilities at our disposal. How do we make the most out of this? So that total portfolio approach, which we actually have been thinking in those terms really from pretty much the beginning of the organization, about 7 or 8 years ago, we took a big step back and said, how can we do this in an even better way? And that's really when we developed a new framework called our Total Portfolio Investment Framework, which we can talk more about. And that was really all about how we can make these pieces that we have greater than the sum of their parts. And so that's one of the key areas that I've been working on for the past several years is developing our total portfolio approach and that framework.
I love this idea that I'm getting the image of the Canadian pioneers. You said forging ahead in an area that had not yet been explored. So going back to then, what exactly, maybe if we can define this total portfolio approach and what it means to you, and I suppose maybe some of the advantages and benefits of it.
So the total portfolio approach, it's a pretty broad concept. And one of our peers, so we recently put together a paper with Kaya and some of our peer funds. And one of my colleagues at one of the funds has a great way of saying it. He says it's a state of mind, which means a lot of things. But if we try to be more concrete than that, there's really a couple elements of a total portfolio approach. So there's governance, there's how you diversify your portfolio, there's how you allow your capital to compete, competition between ideas, and then underlying, there's a culture. So if you start with governance, one of the key challenges that you may face, if you have a strict strategic SAA, you're essentially given predefined buckets of assets that you are then challenged to fill up in the best way that you can. So that's a very different model than a total portfolio approach, where what you're trying to do is construct the best overall portfolio to get the best risk-adjusted returns. And when you look from the top down into those asset classes, you look at those asset classes and what you do differently when your mindset is constructing the best overall portfolio as opposed to construct the best private equity portfolio, the best credit portfolio, et cetera. So then the next piece is thinking about how we diversify that portfolio. And for us at CPP Investments, this is really about looking at investments through a macroeconomic lens using a factor-based approach. For us, that allows us to really identify the underlying risk-return trade-offs that we're making and make sure that we are really, truly diversified. And when we think about the next piece of that competition for capital, we need to make trade-offs. We need to make trade-offs between assets. Are they better diversifiers, one versus the other? Is the alpha that we're going to get from one investment better than the other? So how we think about making these trade-offs is a key component of the total portfolio approach. And these trade-offs will be across asset classes because we're no longer just worried about filling, a particular bucket with the best investments that we can. And the last ingredient, but certainly not the least, is the culture aspect of this. And this is really, really important because what we want and what makes the whole total portfolio approach successful is having people who are aligned to that goal of building the best possible portfolio, not necessarily what is best for their specific asset class or investment area. So really orienting all of our investors around that common goal is a key element of success.
And do you think an organization has to be a particular size? Because some of these things you're referring to, I imagine you need a certain amount of resources and bandwidth in order to be able to think holistically like that. Or do you think it could be translated into any sort of size of an organization?
I think that the approach that you will take may need to be a function of the size of your organization. So the benefits, for example, a smaller organization has is you can literally put everybody around the table and have a conversation. What's the best opportunity? How should we fix this problem or think about this allocation challenge? So having a small organization can be an enabler in some sense, but having the larger organization and the resources and capabilities that, for example, we have here at CPP Investments allows us to take a quite sophisticated approach to making those trade-offs. We can build up these factor models and model our entire portfolio using that approach in a way that may be much more challenging for a smaller organization to do. So there are positives and negatives, but I don't think it's a one-size-fits-all solution.
We're going to take a short break to hear from one of the sponsors of this series, Ruffer, a London-based asset manager founded in 1994, which manages over 25 billion for institutions, pension funds, charities, and individuals. I sat down with Jasmine Yo, fund manager, to ask her about the role that absolute return plays in a portfolio.
The fundamental role is to provide a solution to the lack of attractive diversifying options to protect portfolios against a reversal, potentially, of the correlated gains across asset classes that we've been enjoying over the last few decades. I think the overarching picture for portfolios today is one in which we think it's sensible to capitalize on the strong market recovery of last year and early this year to prepare for an environment that could look a bit more like 2022. I also think the strong starting position for some asset valuations, together with an increasingly uncertain political and investment outlook, should put the emphasis on locking in some gains today. And that really requires finding assets and strategies that offer genuine diversification in an environment where all assets could fall together. And the Ruffer strategy is looking to offer this, and importantly, the ability to maintain both upside capture, but also the liquidity to inject flexibility at the portfolio level.
And now back to the show. And do you think this is a global movement? Because clearly we've heard a lot about organizations of your size taking this on from North Hemisphere, Southern Hemisphere. What are you seeing your peers doing?
So I think one of the key things that I would see as a commonality amongst peers who are taking the total portfolio approach, and a number have and a number haven't. So I'll start with the ones who have. So the ones who have taken that total portfolio approach, some of the commonalities are really around governance. And they all have similar arrangements of governance that give them the flexibility to make these kinds of trade-offs that you need to make with a total portfolio approach. For example, we have a reference portfolio that helps anchor our targeted level of risk, but we have delegated flexibility in terms of how we allocate around that reference portfolio. So other organizations have similar capabilities or similar flexibility in their governance, can also approach the challenge in a similar way or look at a total portfolio approach. There are differences, and I think that comes back to your earlier point about scale and how much capability you might need to be successful at this. So if I take, for example, the factor lens, and we take what one of our Kaya colleagues called a factor first approach, and that is really embedding how we think about risk and return and breaking that down into the underlying drivers is really at the heart of what we do. It is the foundational component of our allocation processes. But there are other organizations who will look at it and say this might be too challenging for them to take on, or they have a different way of thinking about the allocation process, and they may have more of a factor aware approach where they construct a classic allocation using asset classes and then maybe look at things through a factor lens after the fact. And then you may have another, maybe call it a factor later or factor attribution approach, where other organizations may still take many aspects of total portfolio approach, but they will construct their portfolio in a more traditional or classic way. And then they will use factors as a means of attribution and other types of tools like that after the fact. So there's a different choice that you can make in terms of how you think about the diversification challenge and then where you embed that factor awareness in your process. And I see across our peers different approaches across that spectrum. And then maybe quickly for those organizations who are not taking that total portfolio approach, it is frequently a function of their governance structure or their mandate, which is really just not suited to this type of investing.
Just one question on the factor first approach. I love that expression. It's easy to remember. Do you find the factors are stable? Because I'm just thinking of something like, say, the fixed income, how it's been behaving, perhaps more like equities, correlating more, been more volatile. It hasn't necessarily behaved as we would think it would. Yes, there's factor stability.
Yeah, so that's a great question. And I think it leads to some of the challenges that you can have when taking a factor lens to looking at investing. So it's not an easy path to do all of this modeling work. The models need to be consistent across asset classes, and those asset classes can be very different. Public fixed income versus private equity. And you're trying to put all of these things on a common basis in order to think about the trade-offs that you're making. The other aspect of it, which you've highlighted, is those macroeconomic relationships change over time. So what we aim to do is try to get at the underlying drivers of those asset correlations to get more stable factor correlations that are the underlying drivers of the asset correlations. But the challenge, as you say, is being very aware, and we do a lot of stress testing, scenario analysis, looking at models from different perspectives to make sure that what we are doing is going to be robust to changes in those relationships as they do evolve over time. And that fixed income equity correlation is a very important one when we think about portfolio diversification. And it is one of the critical decision points that organizations need to make when they're trying to manage the biggest risk that most equity heavy investors will have, which is to growth. If they want to hedge growth, the main tool to do that is with fixed income. To the extent that that correlation is moving around and perhaps becoming positive, that creates challenges for those investors who are trying to diversify that risk factor. So you're completely right on that.
I suppose this section of the podcast might be, well, what else is going on at CPP Investments? Because we hear so much about some of the forward-thinking work you do around disintermediation, perhaps, and co-investing, private equity investing, the use of alternatives. Can you tell us maybe a few other developments or trends that you're working on within the group?
I can break that into two pieces for you. I think as we look forward, some of the big things that we're worried about or thinking about at the top of the house are around some of these harder to quantify risks. So I could start by mentioning a few of those. So one of those would be climate change and thinking about climate related risks. So there'd be both transition risk and physical risk. And we spend a lot of time and attention on this. So we want to understand, firstly, what those risks are, how is our portfolio exposed to those risks, but also thinking about the opportunities that may arise through a transition. And one way we've expressed that is through, we have a commitment around green and transition assets. And that's a way for us to think about how we can both manage the risk related to transition and also lean into the opportunities related to the transition. The other area where we spent some time thinking is around geopolitical risk. And one of the challenges one has when looking at classic macroeconomic models is they assume, the world is fairly well functioning. And we've seen in the past few years a world which has become a lot less certain. And one of the tools that we're building into our process is the ability to incorporate that uncertainty around when we're doing our allocations around geopolitical risk. So that's another area that we have a lot of attention focused on. And kind of the more kind of classic macroeconomic things that we're thinking about, inflation has been high. It seems to be coming down, but we could be entering a world where inflation's not quite as well anchored as it has been. Could be higher, could be more volatile over the coming years. And so making sure that our portfolio is resilient to inflation is another area that we're thinking about at the top of the house. As we go down, I think you're asking about how do we think about active versus passive and public versus private investments. One of the things that we are now spending a lot of time on is getting even better at making those trade-offs across those very different types of investments. So breaking down each of those investments, if I think about private equity as a growth exposure, but plus some exposure to liquidity risk or illiquidity, some other risk premia potentially. And then on top of that, some alpha because we have internal capabilities we built or with respect to partners that we're investing with, their active investment capabilities. And that's how I would think about a private equity investment. And now I do that with all of the other investments that we have. And then we think about how do we best get that benefit of diversification, but also try to maximize the alpha that we can get across those investments. So that kind of relative value thinking is an area where we have a lot of focus right now.
So overall, besides this in terms of resources, which we just talked about, what would be some of the maybe pros and cons, advantages and shortcomings of the total portfolio approach in your view?
So the total portfolio approach gives you an opportunity to have a better diversified portfolio. You can really get at the underlying risk return drivers. Again, your goal is overall total portfolio, not specific to maximizing the returns within an asset class. It also creates a flexibility because you can move between those asset class labels, and asset classes to some extent are substitutable for each other. So if I think about private equity as being a leveraged form of growth exposure, or real estate being a combination of growth and inflation exposure, kind of equity and fixed income, I can think about keeping the overall portfolio level by moving between those. So there's a flexibility that is afforded to using that total portfolio approach, which is not there when you use the more classic strategic asset allocation. It also allows you to make those trade-offs when you have to, thinking about different asset classes, different returns, what's beta, what's alpha, when you can put all of your assets on a level basis and compare them. And really, it does come down to what your belief system is. So at CPP Investments, we do have a strong belief in those underlying macroeconomic factors as a driver of asset class returns. It also helps us resolve the curse of dimensionality, because we are not trying to solve for many, many different things. At its core, we're trying to solve for a very small set of macroeconomic exposures that we want to keep the portfolio robust to. So that helps us on that front. So I really do think it overall gives you a better insight into your portfolio and a better ability to control the risk return profile of your portfolio. But it is not an easy path. Trying to reflect all of those assets through a factor lens does take intense quantitative analysis. It takes time and effort. And then being able to be consistent across asset classes is a challenge. So we do mitigate that through stress testing of models, making sure we account for shifting macroeconomic relationships, et cetera. But that is one of the challenges that you face when you take that path.
I'd love to move to some personal reflections now. So would you have any advice for your younger self or any creed or motto that you live by?
Yes. So I think if I look back, and as I said earlier, my career has been very nonlinear. And when I think about how do I answer this question, I say, I don't think it's great or one should be overly focused on an endpoint career goal, but really more have a goal somewhere in mind, but think about the opportunities that are in front of you today and to be open to new and different challenges, even if they're not in your direct linear path. If I look back over my career, many things, opportunities have come up that I didn't expect. Opportunities that I hoped to get didn't come up. Things have worked out. And my path has been a really interesting one. And I think that the key ingredient for me there was being open to those new challenges and being willing to take them on and being prepared. You know, as they say, luck is being at the right place at the right time, but knowing what to do when you're there and having the skills to be successful in that moment. So I do think that's helpful. And just being not overly focused on a linear career path, I think has been a great benefit for me.
And that said, though, being close to 16 years, based on my LinkedIn calculation at CPP Investments, it's quite an extraordinary tenure. What motivates you about working at an organization over such a long period of time?
For me, it comes down to the mission of this organization. So when I walk out of the office, pretty much every person I see, or many of them, is going to be a contributor or beneficiary of the work that we do. And I will say, if you work at CPP Investments and you happen to be here in Toronto and you go to any family gathering, you will no doubt be asked, how is my pension doing? And you want to give them a great answer to that question. So it's a responsibility that we take very seriously. And all of my peers here who are here in this organization are here because of the mission and what we do. And ultimately, as one of the pillars of our pension system, we are making this country a better place, helping improve the livelihoods of our contributors and beneficiaries. And that is a really strong motivator for me to get up in the morning and do what I do.
Well, thank you so much, Derek. I think you put that extremely well. It is a very privileged position that you hold. But I think as an investment professional, it's also a privilege to be able to fulfill this mission and push the boundaries of investment thinking and innovation at the same time. Not everyone in public service can do that. So thank you so much for coming here and opening the hood a little bit of what goes on at CPP Investments, explaining the total portfolio approach, which I think we're going to hear more and more of, and for sharing other insights with us.
Thank you so much for having me, Ethan. And I would just like to say you've done a great job in this podcast of bringing many diverse voices to the table and allowing us as listeners to hear from them. So it's a real privilege, not only to do what I do, as you say, it is a great privilege for me to have the opportunities to do what I do in my professional career, but also to be here on this podcast. Thank you.
Well, thank you so much. I'm Ethan Devitt. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear more inspiring investors and their personal journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. You can find all of our content on the 50 Faces Hub, where you'll find a library of role models, resources, and other solutions to enhance your career. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.